Welcome to the Deep End by On Deck, a podcast where visionary builders, creators, and experts discuss world-changing ideas. I'm your host, Marshall Kozlov. Let's dive in.
Two-part wonky answer is the stock market exists in our society to help allocate capital to companies, right? And make sure that companies that need to raise money to invest in projects and ultimately drive a return and actually do societally productive things. And we determine societal productivity by the distribution of money, doing societally productive things that they can get capital to do those things, right? And that's like point one. Point two is, the next more granular wonky point there is price discovery, right? And making sure that we can sort of at any moment on any day have a reasonably accurate price of the value of a given company and the projects that company represents. And again, that goes back to the efficient allocation of capital. Those are the wonky answers. The real answer and why most people and why we're so excited about expanding access to the capital, to the capital markets and to the public markets in the US is that it's the greatest wealth creation engine ever created, known to man.
At the Deep End, we're creating a space where we skip the surface level and go in depth into ideas that inspire people to build. I'll be your guide as we explore possible futures of internet communities, creator tools, climate tech, longevity, and much, much more. There are no experts in uncharted territory, only pioneers. The Deep End invites these trailblazers to turn their experiences into the knowledge and ideas that others need to start their own founder odysseys. Joining me this week in the Deep End is Stephen Sikes, Chief Operating Officer of Public. Today's conversation is about how millions of people are entering the stock market for the first time with mindsets and behaviors unlike any generation that's come before. New investors, particularly those who've started recently via a mobile app, believe they're part of a movement that's making investing more inclusive and accessible. Public exists to help these people get started investing and become better, more thoughtful investors too. In that vein, we talked about how to build community through investing, how to build financial literacy, especially in regard to meme stocks, and the benefits of fractionalization. Stephen labels the stock market as the greatest wealth creation engine ever known to humanity, but we also examine that statement through the lens of crypto markets over the last decade. Stephen's built much of his own success through good timing. He started investing when the market was at a low point during the financial crisis in 07-08. We draw parallels between that opportune moment and the one that many others have found themselves in last year during the height of lockdown. One huge difference between those two moments, the number of folks who are empowered to invest has skyrocketed. The implications of that and more ahead in today's episode. Let's dive in. Stephen Sikes, welcome to the Deep End.
Thanks for having me. I'm happy to be here.
Yeah, glad to have you. I've been saying this the past couple episodes, but we tend to have guests with interesting backgrounds, so I will continue to break my habit of not bringing folks' background into the conversation of the episode. So you have been in the industry for a bit. You were at McKinsey. You were in the Army before all that. So I would love for you to tell a little bit about how you got interested in investing as a category to actually work in, because given your background in the Army, at McKinsey, you quite literally could have gone basically anywhere directionally. So I'm curious why you zoomed in on this part of the market.
I think I'll go back to sort of when I was in college and really got my first taste of what I'll say is self-directed investing. I think when I was a little bit younger, my parents set up a small custodial account. I owned some mutual funds when I was maybe in high school. But I think when I went to college, and specifically I remember as a junior in college, I had the opportunity to take out this great pre-commissioning loan that USAA offers and used to offer, which is basically like a zero interest, $20,000, $25,000 personal loan that you don't start paying back for like 2 years after you start in the Army. And so I all of a sudden, took this thing out because it was basically free money. And I was like, took enough economics classes to know that was a pretty good idea. And it just so happened that this $20,000 landed in my account in like the second or third week of October in 2008. And so I don't know how many of your listeners are as old as I am, but that was literally sort of in the early, the mid
Something
throes of
was
the financial
happening.
crisis, and sort of over the next 3 weeks, I think the financial markets all cumulatively lost something like 20% or 30% over a few weeks, and then just continued to bottom through April 2009. And so I'm sitting there with this big bucket of money. I'm in college. I don't got anything to spend it on, and I decided, hey, I'm going to try my hand at investing. And so I opened up a brokerage account, one of the low cost brokerages, and started buying stocks, especially as they all fell. And I had tried my hand at it, thought I was a really good stock picker. Some of them turned out really well, some of them not so well, but that was sort of the nature. And ever since then, I've just been really interested in sort of what are the things that help people get started investing, right? Like that was a formative moment for me. It was both the volatility and interest in the markets tied to the financial crisis, which I thought was sort of fascinating, interesting thing to learn and study. It was the particular time in my life where I had some time to spend doing it because I was in college. And then also just tracking my own progression as an investor and how I've learned and what experiences I've had, what products I've experimented with, and how I've ultimately gotten to what I think is, a pretty fundamentally sound investor. I still, buy pretty speculative stuff from time to time, but I think I've try to follow the academia and the research in terms of what are the right investments to make, and just tracking that sort of progression over time, just with myself, has led me to a big interest in the space. And so when I was at McKinsey, like you said, I naturally gravitated towards financial services. I'd be lying if I said a small part of that wasn't because I wanted to stay in New York instead of traveling all the time. So I ended up doing a lot of financial services. Being a young sort of digitally native person, I gravitated towards digital strategies and that sort of stuff. And so I ended up doing a bunch of wealth management, asset management, retirement, life insurance based digital strategy work, which sort of naturally led to where we are today.
And you remained in New York successfully, I'm hoping.
Relative to the consulting, to the average consultants, I think I probably spent 50, 60% of my time in New York in my consulting days, which was good. New York's a great city. I want to spend as much time here as I could.
Not bad. I love the way you started out that story in the sense that you're in college, you're younger, you have a pot of money, though not a game-changingly large amount of money. I would say that probably mirrors directionally the experience that lots of young investors had over the past year, given stimulus checks, given the fact that a lot of people cut back their spending because especially during the lockdown, they weren't really going out. And that's a dynamic that people really frequently talk about when they talk about the general investing space. So I'm just curious, what would you advise people thinking about that type of situation, which has become much more normalized?
Yeah, I would probably start by saying, hey, don't borrow $20,000 to invest. It just so happened this is what I did. And I thought this was, 21-year-old me thought that was smart. There were some plenty of other things 21-year-old me thought was smart that maybe wasn't so smart. But so I'd start there and say that's great. I mean, I think one of the trends that we've seen in the industry overall is just the reduction in cost, even relative to then 13 years ago. We've seen it become much less expensive to invest, right? I picked sort of the lowest cost, you know, lowest commission brokerage I could at the time, which I think was $5 a trade, right? And even that seemed like a lot, right? I'd go and I'd try and, I'd buy, you know, a couple of shares of Apple or whatever, and spend a few $100, and all of a sudden I was spending 1% of, the $500 investment I made. I was spending 1% of that in commissions, which is like a really high, like that's a really high commission rate in this day and age. And so what we've seen over even again the last relatively short period of time is it increasingly be easier to begin investing with even smaller amounts of money, right? And I think that gives us all the opportunity to start investing in a broader set, more diversified portfolio earlier on in our lives. Because again, you can, sign up for public, no account minimums, $1 fractional shares, and with $10, you can buy 10 different sort of stocks and ETFs that like create a reasonably diversified portfolio. You can do that every week, and do it every week, every paycheck, and actually end up with a fairly decent chunk of money in the long run. I think that's mostly what we try to do. The other thing I'll say is, having been working on this problem and really the problem of helping people get started investing for the last, 4 or 5 years in a really dedicated fashion, most people don't necessarily start with the best investments, right? Like they sort of start like I did, right? They start with buying things that are, you know, really volatile, falling off a cliff. Like I bought a bunch of AIG stock back in 2008. Anybody who was alive for the time knows that probably wasn't a very good bet. But it's what I did, and it's how most people. Again, we found most people start. They like to start with companies they know, interesting things that are going on in the market, things that are newsworthy, and they start there. But what we found increasingly is that even when people start investing, and to be really specific, when they start investing in sort of meme stocks, even, right, where the first thing they come in and buy is AMC or GameStop, what we see is both from the data that we have and a recent survey we did called The Outsiders, where we asked those people what they do subsequent to starting investing in meme stocks, most of them diversify, and they do it in a really healthy way. I think 81% of them is the specific number, I think, from the Outsiders survey. 81% of them, folks that started investing in a meme stock, actually diversified in relatively short order and plan to be long-term diversified investors. And I think that's, it's great. So again, it tracks a little bit my story, but again, I tend to believe in sort of vanilla passive investing is going to give people the best long-term risk-adjusted return. But I think it's also great to be sort of actively involved in one's investments and be able to do sort of both those things at once.
I like the way you laid out the meme stock to diversified portfolio transition. Obviously, it's a broad survey, so we can't be specific and ask you to play the exact mental framework of people who are doing that. But I'm just interested in how you think about that at a platform level, because I remember the meme stockiest point in the news cycle, and I was sort of like AMC, GameStop, et cetera, et cetera, et cetera. How do you get people, or how do people just go from that hype cycle to saying, hey, but by the way, I should also maybe diversify my portfolio? It just seems like there's a huge distance between the actions or the motivations that are driving those two things.
Yeah, and so I think I'll start and introduce Public for those of your members, listeners that haven't heard of us or aren't familiar. But we're an investing platform, and we are a mission-driven investing platform, and we exist to help people be better investors, right? I think our pithy mission statement pretty clearly is to make the public markets work for all people, but we break that down really clearly. And when we say work for people, what we mean is actually help people be better investors and have better long-term investing outcomes. So we're really obsessed with this question. The truth about helping people be better investors is you can't help people be better investors until you get them to be investors in the first place. Mm-hmm. And so again, meme stocks specifically is something that has gained a ton of press attention and a lot of sort of attention throughout just a much broader part of the population than investing usually does, has been great to service that first part of helping people put that first dollar to work and get interested in the markets and understand sort of the power of and the wealth creation power that the U.S. public markets offer. And again, amazing things like compounding returns, where you can put a little bit of money in an investment account, invest in something responsible, and go away for a while and come back a few months or years later, and it's probably going to be worth a little bit more. That's pretty awesome, right? Did no work, and my money's worth a little more today. Again, helping introduce more people to that concept is incredibly important. So we take a pragmatist approach, right? Which is, in order for us to help people be better investors, we have to help them get started as investors in the first place. And things like meme stocks absolutely have raised the profile of investing and gotten an entirely new class of people to begin investing. So how do we connect sort of that pragmatist approach where people are starting with things that we might all agree are suboptimal, right? You probably, listen, if the only thing you're ever going to invest in is AMC and you're going to hold it forever and ever, yeah, I don't, the research says that's probably not going to give you the best long-term risk-adjusted return. And I tend to trust that sort of research and trust the theories behind it. But what we've seen increasingly is that those folks come in, start with something you might agree is suboptimal, and then over time get more exposure, and they learn, right? They learn by doing, and they learn from other people. And so I think where we spend a lot of time, where Public really excels, is in the second one, is we've created a community of investors around this concept of helping people get started and helping people be better investors. And the community that we've got on Public does a really great job of driving a constructive discussion about the markets, about new companies, about different investing approaches and principles, and making it an easy way for, again, those relatively new investors to start learning and have a really natural way of getting up the learning curve and ultimately improve their behaviors.
Something I'm wondering about, given your reference to community, without asking you to specifically comment on this community, when people hear community stock markets, they're going to think of just, Reddit. They're going to think of Reddit and the specific community that was behaving that way, for good or for ill, depending on your perspective. What, from the public perspective, have you seen come out of the community aspect there?
Yeah, so I think there are a couple things. Again, let's go back to this idea of helping people get started investing, and there are a few barriers to investing. And I think one of them that doesn't get we talk a lot about a barrier of access. And access, when people talk about access, they mostly mean cost. And that's obviously the industry as a whole has done a great job of bringing down the cost barriers and no commissions, fractional shares, no account minimums, incredibly low fees. All of that stuff is fantastic. But what people don't talk about as much is inclusivity, right? And I think what our research has told us is that most people get started investing and learn about investing from their friends and their family. And so there are communities in America today that are just underinvested and have been for generations. And so I was lucky. My parents were investors, and they introduced that to me at a young age. Not everyone has that, right? And so if you're somebody coming from one of those communities and you're trying to get started investing, and you've got absolutely no one that looks like you, sounds like you, that you can talk to about the idea of investing and learn from in a comfortable place, like it's going to be a pretty high bar, a pretty big barrier to you actually getting started. Whereas on public, like again, we've intentionally built the community from the ground up with inclusivity at the core, and we've tried to find great sort of financial analysts, people that care about the markets, that are capable of creating content that represents an incredibly diverse group of an incredibly diverse group in aggregate, right? And they represent as many sort of corners of America as we can get, and in doing so, the community that's evolved around those sort of cornerstone creators has become a really inclusive and constructive place, and a place where we find a lot of our members show up and are able to sort of ask the questions and learn from others in a place where it's comfortable and safe, and again, like I said, from people that they feel like they can trust and rely on.
Here's a question that I've always kind of wondered at a more meta level, and that was frankly never really effectively answered during the meme stock news cycle. What is the purpose of the stock market? Right. And I'm not asking that like at a literal level. I'm asking it at a metaphorical level, because if you look at a lot of the controversy that came out of the GameStop AMC bit, it was, hey, like the stock market is this giant casino and the system's unfair because it only lets some people risk everything in this giant casino. And we need to make it more accessible to everyone to do that, whether that's good or not. There's a degree of like nihilism to that take, especially when you're playing around with your stimulus check. But I think what I'm kind of getting at is like, just when you see the stock market and you see communities, different groups of people who want to get more access to it, like at a core, like what are they getting access to?
Yeah, so I'll give you, since you asked the question, I'll give you like the two-part wonky answer, and then I'll give you like the real answer. The two-part wonky answer is the stock market exists in our in our society to help allocate capital to companies, right? And make sure that companies that need to raise money to invest in projects and ultimately drive a return and actually do like societally productive things. And we determine societal productivity by the distribution of money, doing societally productive things, that they can get capital to do those things, right? And that's like point one. Point two is, the next more granular wonky point there is price discovery, right? And making sure that we can sort of at any moment on any day have a reasonably accurate price of the value of a given company and the projects that company represents. And again, that goes back to the efficient allocation of capital. Those are the wonky answers. The real answer, and why most people and why we're so excited about expanding access to the to the capital markets and to the public markets in the U.S. is that it's the greatest wealth creation engine ever created, known to man. And there's, to expand access to that to a greater, larger population means that we can really help people have more money in the long run for whatever goal that they have, right? Just to achieve financial independence, to be able to save for their kids' college, whatever it is that they need to do over the time horizon. Investing rather than keeping that money in cash, or definitely rather than spending it on something, is ultimately going to enable them to be happier and more successful, and in the long run. And I think that's what it comes down to, right? It's like the reason the stock market exists and the reason we're excited about bringing people to it is because we think it's a great engine for helping people have more money in the long run. And it's the best one. It's the best one we've seen. And we think that creates a ton of value. And as a business, right, our job is to show up every day and try and create value for our members and customers. And again, we're convinced that the best possible way to do that, out of all of the things we could have invested our time into, is helping people grow their wealth by investing, in the public markets.
That's the perfect chance to pivot to the fact that you all have added crypto as an asset class. There's two levels that I want to ask this question around, and you've demonstrated your ability to answer questions in two different directions at once. So I will take advantage of that. So the first most obvious question is, isn't the more obvious take that I should just take my money and put it into Bitcoin and just not even screw around with the stock market in the first place? Because if you're taking this to, 2013, which was a greater driver of human wealth between these two things? The answer, obviously, in the short term is crypto. So how do you just think about that narrative level of the stock market / crypto? Are these oppositional? But I mean, if it's added to your platform, they're obviously not. So that's the second level you could answer the question around.
It's a really tough question. I mean, I think what the research has shown us is we believe in building long-term, well-diversified portfolios, right? And crypto is a relatively young asset class, like maybe 10 years of experience here in Bitcoin, way less in other cryptocurrencies. It doesn't have a ton of experience in terms of how this asset class specifically contributes to diversification, right? And ultimately to that benefit. But I think, again, depending on exactly who you read and what you believe, there's at least some basis of evidence that adding some crypto to your portfolio can have a positive impact. You're absolutely right. When you look at just like point to point and say, hey, I could have bought Bitcoin for $10 in 2011, and today it's worth, whatever, $55,000. Obviously, like everyone would love to have done that in hindsight, but we're not playing in hindsight, right? And the overwhelming likelihood is we're not going to see that same, 50,000 50,000x or 5,000x increase over the next 10 years, right? That would imply some pretty astronomical value of Bitcoin, probably, beyond the total wealth that exists in the world. So again, past performance there's not going to indicate future results, and it never does. But I think we think that crypto in aggregate can have a good sort of can have a role in a diversified portfolio, again, keeping it within a reasonable portion, and that's why we've turned it on. And listen, I'd be lying. We turned it on because it, again, meets our mission in terms of helping people be better investors. Mm-hmm. The other two parts that are really important are, one, a lot of people are getting their first exposure to investing in cryptocurrency. And so we wanted to be where they were, right? In order for us to fulfill our mission of helping people be great investors and really grow their wealth and actually have great financial outcomes in the long run, we had to be in crypto. And we had to have it as a place where, hey, people can come in, invest in crypto, engage with the broader community and talk about crypto, and really sort of use that as a way to begin to learn about the public markets and learn about investing. We had to be there. So for sure. The second thing is, anytime we asked our members for anything they wanted from a feature perspective, everyone answered crypto. It was like 70+% were like, oh, you're asking me what I want for a feature? Build crypto. Oh, build crypto? Build crypto? Yeah, we'll build crypto. So that's ultimately, where we ended up. But I think, again, to come back to your original question, we think it's, crypto can provide some diversification benefit in a well-diversified long-term portfolio.
I don't know if you know this, but I'm curious, what was the second answer for what people were looking for from the platform? Because if you're thinking about it, the crypto one's AKA the real answer to a certain degree.
Yeah. So the other one's very, very clear, and it kills me, and we're working on it, is recurring investments. So basically letting people come and say, hey, I want to invest $50 out of my paycheck every 2 weeks into the, Vanguard S&P 500 fund or whatever, right? And actually build that sort of dollar cost averaging, cash flow based investing model. And so we're working on it. That's coming in the not too distant future. We had to get crypto out first, and now we're focusing on recurring. But recurring is by far the number two. And I bet if we asked our community today, I think that would probably be the one they'd highlight as number one. Now that crypto's on its way out, not totally out, but on its way out.
I'm interested to go back to your origin story in this space. People's answer to this question reveals a lot about themselves as investors or just consumers of information or narratives. Let's pretend you got your USAA funds, let's say in 2013, 2014. If you'd had the chance, would you have put all of that into Bitcoin? I wouldn't have. Because you're right, you can't go back in time, but I think the question is still important because the point I have to be honest with, I would have thought it was weird. I wouldn't have done it. I would have done other things, but I would not have made that 55, percent return that you're discussing. But what would you have done, do you think?
Yeah, I'm trying to remember. I was aware of Bitcoin relatively early. I was at McKinsey in 2013, 14, 15. I was like trying to stay on top of what was going on in like early fintech and like startup world. And so like I knew that Bitcoin and this thing called Coinbase was there and that was interesting. And so I definitely like, I don't even have to think about, like, I know I had the opportunity and I actually did. I mean, I was lucky. I bought, a few Bitcoin, nothing outrageous, but I like was, interested. I had an early Coinbase account and played some of their referral programs, which were pretty good after their Series A, if I recall correctly. And so like, accumulated not, again, not an enormous number of Bitcoin, but a few. But no, you're right.
You still work for a living is the
It
answer.
was a relative, yeah, exactly. I'm not running my crypto family office or anything like that. No, but it was, I was there and I was a pretty active and engaged investor in my broader portfolio. I realized this was a new, interesting asset class, really speculative, and said, hey, I want to have a little bit of that so I can learn about what's going on and stay up on the trends. But no, at that time, it was a much different place. And I think like, there was a lot of risk that it wouldn't be worth anything at all, right? And it was definitely not taken for granted that it would be where it's at today. And so certainly, I wish I'd been a little more aggressive, but again, I think similarly, I viewed it as a small speculative part of my overall portfolio, and it turned out reasonably well, but not yeah, like you said, not I can't quit and start my family office. So.
Yeah, I think in your defense, I think literally every single person listening to this podcast wishes they were put in a little more money into crypto assets back then. Something that I'd like to discuss a bit more is the Outsiders report that you referenced. Two different levels I want to discuss. So one would be the sources of news and information around where people get their investing advice from. I'm personally really interested in the history of the internet. And if you ever read a history of the internet in the 1990s, it focuses a lot about how you had people in their basements investing and buying stocks. And in all those narratives, everything is about CNBC, cable, like that very specific model, which was innovative at the time, but obviously does not feel innovative today. So now in your y'all's data, you have podcasts, you have Twitter, you have all these different spaces. Like, what do you just think broadly about the outside media and consumption space that your users are looking at? Like, is there ever a world where, I don't know, like Public says, hey, like maybe we should have like an investing podcast, or maybe we should create our own content around these things? How do you just think about how media plays given these type of systems?
I mean, one, The Outsiders was an awesome report. We really enjoyed working with the nonfiction team, who are our sort of journalistic-esque research partners in the endeavor. And what I think we found about how people consume information is, they sort of rely on the two most obvious things you would expect. And I think those both come back to like a lot of what we value at Public. First, they rely on their community and their friends and family. Again, talking about money and investing and things like that's a little bit touchy, and people tend to have those conversations in smaller, safer places, right? For one, and then the second, the corollary to their community is that on Public, we've sort of created similarly safe, inclusive, and constructive community that can help people again that maybe don't have a lot of existing investing experience in their broader community. The second thing is people say that they rely on their sort of investing app for information, right? And wherever they go to invest, that's most likely where they're going to pull information. So we view that as sort of a sacred responsibility for us to, one, present the most accurate and up-to-date information about investing, and high quality market content and news, again, some of which comes from the community, some of which we find valuable third parties from. And we think that's incredibly important. And like the opportunity that gives us is to help people again in that sort of learning by doing. The more better content we put in front of them about sort of what's going on in the markets and how they're investing, that's going to help them ultimately be better investors and understand the markets. So the last thing that I think surfaced from the research report was just that beyond those sort of two, there's actually a proliferation of really great investing content and research available in the markets. And when I say the markets, I mean, what I really mean is in the palm of one's hand, right? Like I can go in relative to 13 years ago when I got my start investing, the amount of information I can find and the speed with which I can find it and the convenience with which I can find it is unparalleled, right? It's crazy. And so it keeps people better informed and better engaged with the markets than ever before. And I think that's, again, we absolutely have a goal of making sure that public's a great place to find that information, but we also recognize that people are more informed and have more choice about where they get that sort of content and media from.
And something to pivot back to something you said a little earlier, let's just say I'm a user, I get on public, I'm there. What is the long-term problem I'm facing as a person who's trying to build a portfolio and trying to actually generate the long-term value you're talking about? Because to your point, it's the ability of your platform in a very crowded space to solve that problem that's going to drive the long-term engagement that you actually need.
Yeah, I mean, I think there are a couple of legs of the problem that are a little complicated. I'll be a little tongue-in-cheek and say the first part of the problem is you, right? And our own emotions and reactions to watching the markets and being able to, responsibly and almost coldly approach the content of investing. Because again, all of the research tells us that the more emotion gets involved in making investment decisions, the more people trade, and the more people trade, the worse outcomes they have. And so I think actually resisting the urge to have those sort of knee-jerk emotional reactions to the markets is incredibly important. I think we're our own worst enemies. And I think the solution to that problem is by giving people tools that let them both engage with the markets and understand the markets in a way that's fun and interesting. Because you know what, investing, it's okay for investing to be fun. It's great if it is. And, keep and have great tools for, set it and forget it, right? And letting those sort of be separate things. Let us engage with our portfolio here and maybe have a little bit of money that we get to sort of invest speculatively or based on our own engagement or hypotheses. And then let's have more of the money, the majority of the money invested really responsibly in a way that's aligned with my own personal risk tolerance and goals. And I think that's the challenge for a platform like us. And we're in the early stages of getting there, right? We've focused most of our time on helping people get started investing in a responsible way and having a really great inclusive community. I think where you'll see our company go over the next several years is continuing to invest in, better sort of long-term tools that help long-term investors have better outcomes. And it's a fun challenge to attack for sure.
And, as we're nearing the end here, something I have just noticed and I'm very interested in from a more marketing or company framing perspective is that public relative to the competition has gone very into like specific public figures. So, for example, I went to an event that y'all put on with Kinsey Grant last week. Kyla Scanlon does stuff with you. Scott Galloway was pretty prominently featured. What's your philosophy around these prominent individuals and their ability to either like convey something about what you're trying to say as a brand and a company and the value that them being on the platform that they are actually serves?
Yeah, I mean, I think it goes back to the idea of like intentionally building a community of people that we think helps invite and include a broader population in investing and actually creates great content that helps those people learn about the markets in a way that's comfortable, safe, and constructive. And I think those, all the people you just mentioned, including, there are many others we've intentionally worked with directly to help, again, form that foundation of the community and to build a broader community around it. I think it comes back to that, right? We wanted to have we purpose built the community to help us achieve our mission. And the only way to build a community, and like you said, you talked earlier about, let's say, other communities in the investing world that don't have a reputation for being as constructive as public does. And I think the point is, in this space specifically, if you want to ultimately get to a place where it does have the qualities that I described earlier, you have to do it intentionally. You have to start with the right group of people, and you have to make sure that you're creating the right context and the right community guidelines and that sort of stuff to help people really live up to the potential.
So 2 questions to take us out. So one would be, if 2021, at least narratively, was the year of the meme stock and the attention on AMC and GameStop, et cetera, et cetera, et cetera, what are we moving into narratively? How are you thinking about this space? And how do you think the public, to not just use a pun, but how do you just think about the public that you're still trying to onboard? How are they thinking about that? Because I don't get the sense as much that everyone is waking up thinking GameStop, AMC the way they were back in January.
one, I try never to state things about the future of the markets. If I had any idea what's going to happen in the markets, I probably, again, like you said, we wouldn't be talking. We wouldn't be talking here. There's another couple other lines of work that would let me monetize that really well. But I think what we've seen are a couple of trends that will continue. First, I think broadly speaking, specifically the millennial generation, and I think we'll see how it evolves with Gen Z, got a much later start to investing than prior generations. And so what I think we've seen in the last year and a half, is a real, sort of catch up curve for specifically sort of millennials as they've reached, higher earning potential years and have more disposable income actually getting started. Though again, still later than prior cohorts. I think that's going to continue. I think we would still look at sort of the millennial generation, my generation against prior generations, and see that even at this point in our sort of lives, we're broadly underinvested, both in terms of dollars and number and percent of people that are investing. I think that catch up will happen. It's not as though we have different investment needs. If anything, we have greater investment needs than prior populations. So there's going to be this catch up that's going to continue, and it's not so much that the curve is going to be flatter. It's that the curve just is coming a few years further behind. It actually might have a steeper slope. And I think that's sort of where we're at for one. I think the second thing we've seen and will continue to see is sort of the internet and internet scale communities and internet scale media and engagement having an impact on the markets. 10, 13 years ago, if you'd have said retail is capable of dramatically impacting the stock market and prices of individual securities, people have thought you were crazy, right? That's not a thing that happens. Nobody thinks retail is that big of an impact on the market. But what we've seen is this dynamic of the internet plus concentrated communities of investors actually bringing that coordination to bear on particular securities and having outcomes that probably wouldn't have been forecasted. And I don't know how that's going to play out. And I think it's not something that's going to go away, because we certainly have communities organizing online organically all the time, both around crypto and crypto, and I'm sorry, mostly about securities, but it's happening in crypto as well. And I think that's going to continue to happen. It'll be interesting to see the impacts. I think those are the two trends that I most look at, over the next couple of years.
Man, I always curse myself when I specifically number the last questions we're going to ask, because you just said something really fascinating that I want to follow up on. I had no idea that millennials, we're both millennials here, were underinvested. Because if you think about it for a second and go back to our earlier conversation, millennials, Gen X, like we came up on the internet. So from a pure cost, accessibility, because once again, there's always been accessibility and inclusivity issues with investing, but the internet definitely should have pushed things a little better in the right direction. That just on the face of it doesn't make any sense. So could you is this the 2008 financial crisis? Like what's the story there?
Yeah, I think we've done some research on this at a few different points in my career. And I think two different things always come up. One, the mistrust of the financial markets that was driven by the financial crisis, right? And what happened in 2007, 8, and 9 had during a formative moment in all of our lives. Again, the millennials, I think I remember that I was like, call it 21. I think, millennial generation's a little bit younger than me and, a little bit older, but I think having that happen in the formative years of one's adult life or even just teenage life had a pretty dramatic impact. The second thing is the millennials have the highest student loan burden of any generation, right? And so I think we've seen that sort of negative net worth experience in our 20s for a very large portion, especially of the highest income portions of the millennial generation, right? So the people that financed parts of their education ended up having high incomes, but their focus with those incomes earlier on, especially in their 20s, was mostly paying down that debt and even continuing into their 30s and early 40s. And so I think we're climbing out of one lack of trust in the financial system as a generation. We're climbing out of that. And the second is we're climbing out of the debt burden, out of the deep hole of debt that our generation was in through from financing our education.
Man, that's also interesting too, because what you're kind of getting at when you're talking about trust is that's why platforms like Public are important. It's actually, if I wake up thinking, hey, Public is Wall Street, like that's probably not going to encourage me to invest or actually use the
No.
platform. You actually want to be, I want to think of more as, hey, like Public is my smart, it's my app, it's my iPhone. It's that type of experience. So how do you just think about the dichotomy between, are we in finance? Are we a tech company? You're obviously kind of both. Like, how do you just think about how that plays into the question of trust and users' just willingness to participate and actually just spend time there?
I mean, I think the most important thing in building trust is building a reputation for doing the right thing and aligning a business model with your customers' interests, right? I think I said earlier at the foundation, like business is all about like delivering value to your customers, delivering value to your members. And then if you create enough value, you're going to get rewarded for it in the form of, again, charging for different things or getting paid for different things. And right, like our goal, and every great business that's ever been created creates a ton of value for its customers and then keeps a small portion for itself. And that's what we wanted to do. And so we wanted to build a bit, again, that's the plainest definition of alignment of interest. And that sort of alignment of interest is what leads to real trust, right? And following through on that in every sort of part of the business that you build, and building a business model that sort of, again, reinforces that trust and that sort of value creation, is the quickest way. Because I think, consumers have never been, more savvy, particularly for financial products. And, we love it because we do intend to do the right thing, and we are a mission driven company, and we do want to make sure that our interests are aligned, and we do want to create more value than we extract, right? Like we want to make sure all of those things work and line up. And, both because we think it's good business, because building trust, like you said, is incredibly important to growing a member base and ultimately becoming a successful company. And two, because that lets us, if we can continue to create value for our customers forever, they're going to stay our customers, and that's great. And we're going to maintain really long lifetimes of, lifetime value in sort of the business parlance. Like we're going to maintain a really long lifetime value and be able to, have a really great business outcome as a result.
So the actual last question, if we're going with the whole idea of Public and platforms like it serving to onboard people, I'm just curious, not asking you to make a prediction because we're avoiding those here, but how do you think of all the talk around just like Web3 and NFTs? Because that seems to be a place where there's a huge opportunity to help onboard more users, because I do a lot of interviews with folks who are really in the weeds on that type of stuff. And it's just so incomprehensible. It's not even funny. It's the type of, because what's funny is, like, to our earlier conversation, Bitcoin's actually pretty straightforward, right? Like you buy it, it goes up. That's actually a pretty straightforward story to tell. But with all the broader NFTs and those different discussions, when it comes to, like, once again, a portfolio, it's a lot more complicated. So how do you, at what point does that part of crypto start playing a role in what you all are building, do you think?
Yeah, I think about it from two angles. One, I actually think there can be really cool sort of community-driven use cases for Web3 and NFTs, and associating one's digital identity with a particular non-fungible token, non-fungible piece of art. Like I think that's super cool from a digital identity perspective, and let's abstract that from the idea of sort of economic value and are these things worth money. So I think that very cool, something we're obviously always talking about, running a sort of online community. We think about, hey, how do we make the community more engaging and fun? And NFTs are a cool way to do that. People love it, like, right? And we've seen a lot of that around the industry, and it's something we're always talking about. The second thing, from like a pure investment perspective, I think we're open-minded about the breadth of asset classes that can be included in a reasonably diversified long-term portfolio. I think we've seen a bunch of startups, both in sort of the Web3 NFT space and also sort of in other sort of like classic like collectibles verticals, right? Like you've got Masterworks, Rally Road, VinoVest, right? Where they're sort of helping people gain exposure to a bunch of, classic, what I'd say is more or less collectible asset classes, and help build those into a part of a portfolio. I think we're open-minded to that. I think NFTs fit into that same idea of collectibles. Obviously, when it comes to collectibles, and when you're talking about things that don't have clear intrinsic value, you're somewhat relying upon the sort of community value and the scarcity value, or the ascribing sort of societal value to those things. So it's certainly more speculative than a cash flowing asset, but it doesn't mean it can't have a role in a well diversified long term portfolio. The last thing I'd say is, like, part of the fun of working at Public and building a company like this is that we are able to be accessible, and we do take pride in it. So if any of your listeners are interested in reaching out or chatting, I'm easy to find on on Twitter and on Public. So hit me up, and would love to talk about any of the topics or others that we've discussed today.
Thanks for joining us in the deep end. If you enjoyed your stay, give us a review on Apple Podcasts and share this episode with your friends and colleagues to help grow the show with us. We've also got show notes and more episodes available at ideas.beyonddeck.com. See you next time.